we're going to talk a little bit more detail about the major types of investments that you can do. Now, the least risky is investing in cash. What do I mean by investing in cash? Well, it means maintaining the value of your cash, of your money, plus being paid a small amount of interest for the use of your money. So for example, your bank account, your checking account, or your savings account may pay you a small amount of interest to keep your money in the bank. Amounts under $250,000 are insured by the federal government in the United States, so you do not risk losing that money if that money is in a bank account. You could also invest in mutual funds that hold money market instruments. They hold cash and invest in very short-term debts, but it's not insured by the U.S. government, and it will pay a little bit more than banks. You can look up on your Yahoo Finance page the ticker PSHAX, the PIMCO Short-Term Fund, as an example of a money market fund. So what's going on now in July 2018 about cash investing? Well, we've had a change. The economy has recovered from the crash of 2008 and the markets have been rising. The federal government is a little bit worried the economy might be overheating and growing too fast. So the Federal Reserve Bank has started to raise the interest rates. What does this mean if you're a cash investor? It means that your bank deposits and your money market funds are earning a little bit more interest for you. At one point, they weren't even paying any interest. There was actually a zero return for putting money in the bank. Now it's 1 or 2%. So that's good news for cash investors. The next kind of investment that's a little more risky than cash is called debt investing. Sometimes you'll hear people say investing in debt. Sometimes you'll hear fixed income. Sometimes you'll hear the term bonds or loans. They're all basically talking about very similar types of investments. Debt investing is basically lending your money to somebody and you expect them to pay you back plus interest. The amount that they're willing to pay you back is the interest rate. So let me give you an example. Joan wants to open an online business and she borrowed $1,000 from Sally. Joan agrees to pay Sally back the $1,000 plus 5% interest in 1 year. If we take the $1,000 times 5%, we get $50 of interest for 1 year. So Sally will have earned $50 on her investment plus the return of her money of $1,000 in 1 year if Joan repays her. So she'll go from having $1,000 to $1,050. Now, what are the pros and cons of debt investing? Well, on the positive side, your borrower actually promises to repay you all of your money, which is called your principal, plus interest, and you expect them to repay. Now, what is the negative? What if your borrower does not repay you? You can't get your interest and you don't get your principal back. How do you improve the odds of actually getting your money back when you make a loan? You look for something called collateral. Now, what collateral means is something that the borrower is willing to give you to hold or to put aside for you in case he or she cannot repay the loan. Let me give you an example. If you buy a house and you get a mortgage from the bank actually holds onto the deed of your house and keeps that deed in case you can't repay the mortgage. If you stop paying your mortgage payments, the bank takes your house. So that is called a collateralized loan. There are two types of markets that we discussed earlier that you can invest in, private markets and public markets. When it comes to debt investing, private markets would be, say, funding your friend in a startup business or funding a Kickstarter campaign, things like that. Here, the company promises to repay you, but as we just discussed, it could be quite risky unless you have collateral, and it's very illiquid. In the public markets, you can lend your money to all kinds of both government and private organizations in the form of a bond that's publicly traded. So for example, U.S. Treasury bonds are instruments that you can buy where you are lending your money to the federal government. Municipal bonds, you're lending your money to the state government. Now, interestingly, both federal and municipal bond interest is tax-free, so sometimes that's very advantageous for you. You can also lend your money to corporations, publicly traded companies, and they will pay you back your money plus interest if the bonds are doing well. If you want to make more interest, you can lend money to what's called high yield debt, meaning higher interest rate. Now, why are those companies willing to pay you a higher interest rate for that debt? It's because they're risky. They're more likely to not be able to pay you back. So in order for you to take a bigger risk, you are going to get a higher interest rate. But you don't want to put all your money into high rate risky debt because if it goes wrong, you could be losing your money. Now, you may have seen a lot of talk on the television or in the financial papers about the effect of U.S. interest rates on the debt market. What does that actually mean? Well, the U.S. government sets the interest rate for banks, which is called the federal funds rate. When the federal funds rate is lowered to stimulate the economy, meaning the government wants to make it cheaper to borrow money so people will borrow money and start businesses and do business, that's when interest rates go down. Right now, we're in a period where the federal government is raising interest rates because they think the market is overheating and they don't want to trigger something called inflation, which means that in the future prices go up and up and up. In July 2018, the Federal Reserve is afraid the economy is growing too fast, so they're raising the interest rates. That means that investors who have old bonds that they bought a while ago could buy new bonds in the market at a higher rate. And in order to compete, these existing bonds must now drop their price. That means bonds in general are going down in value because interest rates are going up. That is what's happening today in 2018.